When most people hear the words new tax bill, their first reaction is stress. They start worrying about what they'll lose, how complicated their return will be, or whether they'll end up paying more than they should. But here's the thing. Every single tax change comes with two sides: those who get caught off guard and lose money, and those who understand the new rules early and use them to their advantage. The truth is, this new 2025 tax bill isn't something to fear. It's an opportunity. And if you know how to play the game, you can legally keep more of your hard-earned cash while everyone else complains about their refund shrinking. It's not about being sneaky, it's about being smart, informed, and proactive. In this talk, I'm going to break down exactly what you need to do now to put yourself in the winning category. We'll cover how to understand the rule changes, how to take advantage of new deductions and credits, how to tweak your investment and income strategy, and how to set yourself up for the long run. Because taxes aren't just about this year, they're about building a financial future where you're in control. Understand the rule changes before you act. The very first move when a new tax bill drops isn't to rush into changing all your financial habits. It's to slow down and understand the new rules of the game. Because let's face it, if you don't even know what the rules are, how can you possibly expect to win? Think about it like this. If you were playing a board game and halfway through someone swapped out the rule book, you wouldn't just keep moving your pieces the same way, would you? Of course not. You'd stop, read the new rules, and figure out how to adjust your strategy. Taxes work the same way. Every time lawmakers pass a big bill, the game changes, sometimes in small ways, sometimes in huge ones. The people who take the time to understand the details are the ones who walk away with more money in their pocket. So, what exactly should you be looking at in the 2025 tax bill? Let's break it down. First, pay close attention to tax brackets. These are the ranges of income that determine how much tax you'll pay. Even a small adjustment to the brackets can affect your bottom line. For example, if the income level where the 22% bracket starts has moved up, that means more of your money will be taxed at the lower 12% rate. That's a win, but only if you understand it and plan accordingly. On the flip side, if a bracket shrinks or rates go up, you'll need to prepare so you don't get hit with an unexpected tax bill. Second, study the deductions and credits. This is where most people either win big or lose out completely. Deductions lower the amount of income you're taxed on, while credits directly reduce the amount of tax you owe. A new bill might raise the standard deduction, add new credits for families, or remove old ones. A8. If you don't know what's changed, you could literally leave thousands of dollars on the table. Imagine being eligible for a $2,000 tax credit and missing it simply because you didn't take the time to read up. That's like turning down free money. Third, look at the retirement and savings incentives. Governments often tweak rules around retirement accounts like 401ks or IRAs to encourage saving. Maybe the contribution limits have increased, or maybe there are new tax breaks for middle income earners. If you understand these changes, you can stash more money into accounts that lower your taxable income today while growing your wealth for tomorrow. If you ignore them, you miss out on compounding benefits that could add up to tens of thousands of dollars over your lifetime. And don't forget about business-related changes. If you're self-employed or running a side hustle, the tax bill might include new deductions for expenses, equipment, or even home office use. Small business owners often win big with tax law changes, but only if they're paying attention. Otherwise, they keep paying more than they should while their competitors pocket the savings. Now, I get it, tax bills are long, confusing, and full of legal jargon. 8. Most people don't want to spend their evenings reading through government documents, but here's the good news: you don't have to become a tax lawyer to win. You just need to commit to understanding the key points that affect you personally. That could mean reading trusted breakdowns online, following reputable financial educators, or even booking an hour with a tax professional who's already studied the new bill. 8. Think of it as paying for a map before heading into unfamiliar territory. A small investment of time or money up front can save you a huge amount later. Here's where most people go wrong. They hear there's a new tax bill, they panic, and then they start making moves without really knowing what's changed. They switch investments, change their withholdings, or sell assets in a hurry. And 9 times out of 10, they make things worse for themselves because they didn't fully understand the rules first. That's like trying to play chess without knowing how the pieces move. You're setting yourself up to lose before you've even started. The smart move is patience. Step 1 is education. Step 2 is action. By taking the time to really grasp what's changed, whether it's brackets, deductions, retirement, accounts, or business breaks, you put yourself in the top 10% of taxpayers who actually benefit from new laws instead of being blindsided by them. And here's the best part. Once you've mastered the rules, you can play offense instead of defense. You can position your money, your investments, and your income in ways that maximize the benefits and minimize the costs. That's how you turn a stressful tax season into an opportunity to keep more of what you've earned. So before you do anything else with this new tax bill, hit pause. Study the changes, learn how they affect you, and then build your plan. Because when it comes to money, knowledge isn't just power, it's profit. Maximize new deductions and credits once you've understood the new rules of the tax bill. The next smart move is to figure out how to squeeze every last drop of benefit out of deductions and credits. This is where the average taxpayer either wins big or walks away empty-handed. And the truth is, the 48. Most people don't even realize how much money they're leaving on the table. Let's clear something up first. Deductions and credits aren't the same thing. A deduction lowers the amount of income you're taxed on. For example, if you made $60,000 and you qualify for a $5,000 deduction, you're only taxed on a $55,000. A credit, on the other hand, is even better. It reduces the actual tax you owe dollar for dollar. If you owed a $3,000 in taxes and you had a $1,000 credit, now you only owe $2,000. That's like someone handing you cash back. Now, when a new tax bill passes, lawmakers often shift these around. Some credits expand, some disappear, and sometimes new ones get introduced. This is where people who pay attention really shine because they don't just file their taxes the same way every year out of habit. 8. They look at what's changed and make adjustments to take advantage of what's new. Think about families. Big tax bills often increase child-related credits to give parents more breathing room. That could mean larger child tax credits, new education-related credits, or even incentives for childcare expenses. For a family of 4, these changes can add up to thousands of dollars. But here's the catch: you have to claim them properly. Plenty of parents don't even realize they qualify, and they end up paying more tax than they need to. If you're a student or have kids in college, the bill may include education-related deductions or credits. Things like tuition, books, or even loan interest might now be eligible. This is money you're already spending, but if you don't know the law has changed, you'll never see that money come back to you at tax time. Then there are healthcare-related deductions. Governments sometimes tweak what medical expenses qualify, or they raise the limit on how much you can deduct. Imagine you've spent thousands out of pocket on medical bills. Those receipts could suddenly become valuable under the new rules. Most people don't think to look, but the ones who do end up saving big. And let's not forget about energy and home-related credits. New tax bills often push incentives for going green, things like installing solar panels, upgrading to energy-efficient windows, or even buying an electric vehicle. These credits can be massive. I've seen cases where someone's tax bill dropped by several $1,000s just because they upgraded their home and claimed the credit. Here's the best part: those improvements also save you money long term on utilities or fuel, so it's a double win. If you run a side hustle or small business, the opportunities are even bigger. Deductions for business expenses, equipment, home office use, and even travel often get adjusted in new tax laws. Smart entrepreneurs don't just wait until tax season. They plan throughout the year, tracking expenses and aligning their spending with the new rules. That way, taught you eight, when it's time to file, they're ready to claim everything they're legally entitled to. Here's the key takeaway. Maximizing deductions and credits isn't about being shady or cutting corners. It's about using the law to your advantage. The government literally writes these benefits into the tax code to encourage certain behaviors, whether that's saving for retirement, raising a family, investing in education, or starting a business. If you don't claim them, you're basically saying, no thanks. I'd rather give the government extra money. That's not smart. Now, some people make the mistake of assuming their tax software will just figure it all out for them. While software is helpful, it's not a replacement for awareness. It won't magically know about all the changes if you don't input the right information. And if you're not proactive, keeping records, saving receipts, and asking the right questions, you could still miss out. This is why planning ahead matters. Don't wait until April to think about deductions and credits. Start now. Look at the new tax bill, identify the areas that apply to you. 8. And adjust your financial decisions during the year. Maybe that means contributing more to a retirement account, keeping better track of your medical expenses, or timing a big purchase so it qualifies for a new credit. Here's the bottom line: deductions and credits are like coupons in the tax system. The people who clip every single one walk out of the store with bags full of goods and money still in their wallet. The people who ignore them, they pay full price every time. Don't be that person. If you want to keep more of your hard-earned cash in 2025, you need to be intentional about finding and using every deduction and credit you qualify for. Adjust your investments and income strategy when a big tax bill passes. The knee-jerk reaction for most people is to ask, how much more am I going to pay? But that's the wrong question. The real winners are the ones who ask, how do I rearrange my money so I pay less and keep more? Because the truth is, taxes aren't just about what you earn. They're about how you earn it, how you invest it, and when you take it. Let's start with something simple: tax brackets. Every new tax bill shuffles the brackets a little. Some people might suddenly find themselves in a higher bracket without even getting a raise. Others might discover new opportunities to slide down into a lower one. The trick here is to manage your income so you land in the sweet spot. For example, say you're just a few $1,000s over the line into a higher tax bracket. Without planning, that could cost you thousands more in taxes. But if you shift that income, maybe by contributing more to your retirement account or adjusting how you're paid, you could drop back down and instantly save money. Same job, same effort, but a smarter outcome. This brings us to retirement accounts. New tax laws almost always come with updates to contribution limits or incentives for saving. That's the government's way of nudging people to prepare for the future. If the cap on how much you can contribute to your 401k or IRA has gone up, take advantage of it. Not only are you building wealth for later, but you're also lowering your taxable income today. That's a double win. Your future self gets more money and your present self keeps more of your paycheck. Next, 8. Let's talk about capital gains. This is where a lot of people miss out. Capital gains tax is what you pay when you sell investments like stocks, real estate, or even a business. New tax bills often tweak the rates or the holding period required for lower taxes. Here's the key: timing matters. If the new bill increases taxes on short-term gains, holding on to that stock a little longer before selling could save you thousands. On the flip side, if they've lowered long-term capital gains for certain income brackets, you might want to strategically sell now while the rates are favorable. And it's not just about selling, it's also about harvesting losses. If you've got investments that haven't gone your way, you can use those losses to offset gains and reduce your tax bill. Smart investors don't just focus on making money, they know how to manage losses too. The new bill might expand or limit these strategies, but either way, you need to pay attention. Then there's the idea of diversification for tax efficiency. Most people only think about risk when they diversify, but smart people also think about taxes. Some investments are tax advantage, like municipal bonds or certain retirement accounts. Others are fully taxable. The new tax bill might change which ones are more attractive. So instead of just asking, "What's my return?" you should also be asking, "What's my return after taxes?" Because at the end of the day, it's not about what you make, it's about what you keep. Don't forget income timing either. If you're self-employed, a freelancer, or run a business, you often have flexibility in when you recognize income. If the new bill raises taxes next year, you might want to accelerate some income into this year to take advantage of the lower rates. If it lowers taxes next year, then delaying income could be smarter. The same goes for expenses. Shifting when you spend money on business equipment or big purchases can help align your finances with the most favorable tax rules. Now, I know some people might be thinking, this sounds complicated. But here's the thing, it doesn't have to be. The key is awareness and small adjustments. Even something as simple as increasing your 401k contributions, selling investments at the right time, or delaying income for a few weeks can make a massive difference in your final tax bill. And let's not ignore side hustles. The new bill might affect how gig workers, freelancers, or online sellers are taxed. If you've got a side income, it's not just extra cash, it's also a potential tax trap or opportunity, depending on how you structure it. Keeping proper records, knowing which expenses you can deduct, and possibly even setting up a business entity could dramatically cut your tax liability. Here's the bottom line: taxes are a game and the rules just changed. You don't win this game by working harder, you win by working smarter. Adjusting your investments and income strategy means you're not just reacting to the tax bill, you're using it to your advantage. So, while everyone else is complaining about how unfair the system is, you'll be the one quietly smiling, knowing you've positioned yourself to pay less and keep more. And when tax season comes around, you won't be stressed. You'll be confident because you played the game with strategy, not guesswork. Plan ahead and stay flexible. If there's one lesson every successful person learns about money, it's this: those who plan ahead win. 8. And those who wait until the last minute lose. When it comes to taxes, that rule couldn't be more true. The people who only think about their taxes once a year, 8, usually in a rush before the filing deadline, always end up paying more. The people who plan throughout the year, who track their moves, and who stay flexible to adapt to changes, they're the ones who keep the most money in their pockets. This new tax bill is no different. Yes, it's important to understand the rule changes. Yes, you should maximize deductions and credits. And yes, adjusting your income and investments is vital. But none of that matters if you only think about it in April when you sit down with your accountant or open your tax software. By then, most of the smart moves you could have made are off the table. Planning ahead means looking at your money in advance and making strategic choices all year long. Let's take an example. If you know the new bill increases contribution limits on retirement accounts, waiting until tax season to think about it doesn't help. You need to start contributing more now so you maximize the benefit over the course of the year. The same goes for deductions and credits. If the bill introduces new deductions for education or childcare, you need to be keeping receipts, logging expenses. 8, and setting up systems to make sure you can actually claim them. If you wait until the end of the year, you'll have forgotten details, lost receipts, and missed out. Planning ahead keeps you in control. But just as important as planning is staying flexible, because here's the truth: governments love to change the rules. 8. What's true this year might not be true next year, so you can't lock yourself into one rigid strategy and expect it to work forever. That's where a lot of people go wrong. They set up a plan and then they stick to it blindly, even after the laws have shifted. Flexibility means you're ready to pivot. Let's say you plan to sell a big investment in December, but the new tax bill changes the rates for capital gains starting January 1st. If you're flexible, you don't just stick with your original plan. You shift and sell at the time that saves you the most money. If you're rigid, you miss out. Think of taxes like a chess game. You need to think several moves ahead, but you also need to adapt to your opponent's moves. The government makes the rules, but you decide how you play within them. And those who can adjust the fastest usually come out on top. Another part of planning and flexibility is working with professionals. Look, you don't have to be a tax genius to win the game, but you do need to surround yourself with people who know the details. Accountants, financial advisors, or even just taking the time to read updates and guides can make a massive difference. The mistake most people make is thinking, oh, I'll just figure it out when I file. By then, the opportunity's gone. Smart people get advice early, adjust their strategies, and make sure they're never caught off guard. Also, remember that planning isn't just about the next tax season. It's about your long-term financial life. For example, you might think taking a certain deduction this year is the best move, but what if deferring income saves you more over the next 5 years? What if contributing more to your retirement account now means you retire with an extra 100,000 later just because you planned smartly under the new rules? And let's not overlook emergencies. Being flexible with your money also means having a cushion. If you've got a solid emergency fund, you can handle sudden tax changes, unexpected bills, or adjustments in the law without panicking. People who live paycheck to paycheck don't have that flexibility. They're stuck. But if you've planned, you're always in control, no matter what gets thrown at you. The final point is this: don't let fear or laziness stop you. A lot of people hear about new tax bills and they instantly panic, or worse, they ignore them completely. They assume it's too complicated, so they do nothing. That's exactly how you end up paying more tax than you should. But when you take the time to plan ahead and stay adaptable, you stop being a victim of the system and start becoming someone who uses it to your advantage. Here's the bottom line: tax laws will always change. This year, it's the 2025 bill. In a few years, there'll be another one. You can't control that. What you can control is how you respond. If you're proactive, if you keep records, if you plan ahead, and if you're flexible enough to pivot when the rules shift, you'll always stay one step ahead of everyone else. So while the majority of people complain about how unfair the tax system is, you'll be the one who quietly smiles because you planned, you adapted, and you kept more of your hard-earned money. And that's the real smart move.